Good morning and welcome to the Morning Coffee with John Plassard. Today I'm focusing on the strange relationship we had recently between bonds and stocks. The 2-year Treasury bonds yield hit a record low of 0.10% last Friday. Capital fled from safety in bonds after the Bureau of Labor Statistics reported 20.5 million job loss in April and 14.7% unemployment rate. But meanwhile, the Dow Jones progressed at more than 2%. Historically, equities and bonds typically have an inverse correlation. When stock price go higher, money leaves the bond market to chase bigger profit, and bond yields goes up. When yields are down, that flight to safety usually entail a sell-off in equities. So why did the 2-year Treasury note yield drop to a record low Friday? For one, the 2-year Treasury notes was a bit of an anomaly in the bond market with lower yields for the day. Yields on Treasury with longer maturity, such as the 10 years and the 30 years note, went up on last Friday. So the bond market reflected the general optimism of investors that pushed equity benchmark higher. And the yield curve isn't inverted as it was in 2019. The lower yields on the 2-year note could summarize a market outlook that's cautiously optimistic over the long term, but recognizes it may take a year or two for the economy to recover from the COVID-19 completely. It could also be evidence of the Federal Reserve lightning swift pump of massive liquidity into the financial system. The emergency monetary stimulus is unprecedented in speed and scale. It could very well be enough to shake the traditional correlation between these asset classes and inflate the market value of securities in each. Finally, there is also the potential that deflation fears are increasing demand for T-notes, driving down yields as investors seek a higher real return for bond market in a falling price environment. Thank you very much. Have a great day. Read my morning and keep on winning.